routinely say that your home is likely your most valuable asset, and that can be true even with a mortgage. Obviously, the most straightforward way to get cash out of your home is to sell it. But what if I told you there are ways to transform your home equity value on paper into usable credit? I'm Elvira Knips from eXp Realty. I'm going to talk about 3 types of loans, 2 of which will let you leverage your home equity, and the other which can be a good option for older folks who are struggling with keep up with bills but also can't afford loan payments. To begin, if you want your money to be flexible, then a home equity line of credit, aka HELOC, is your best option. This is ideal for something like financing an addition on your home or any other multi-step projects where you want some wiggle room in your budget. A HELOC is a flexible line of credit that you can borrow from as needed, up to an agreed upon limit. People generally get 10 years to draw from one, during which the only payments you are required to make are on the interest, which is usually variable and changes with time. After 10 years, you can't draw anymore, and payments will include both the principal and the interest. This option only really works for people with steady income and can be risky for those who don't have that. Just like any applicant, you will have to prove that you can keep up with monthly payments. If you can't make your monthly payments, you risk losing your home to foreclosure. If you don't need your money to be flexible and you just need it to pay off a single lump sum, then you might want to consider a home equity loan. This one is pretty straightforward, as it is just a fixed rate loan that lets you convert a set amount of your home's value into usable money. Just like with HELOCs, you'll have to prove your ability to pay before a lender will consider granting you the loan, and inability to pay can lead to foreclosure on your house. A fixed rate makes this the overall safest option for homeowners, as payments are more predictable than in a HELOC with a variable rate. Reverse mortgages can be a good fit for retirees who are struggling to pay the bills, but they can be risky if they are not required to be paid back until you move or die, at which point they become the responsibility of your heirs. When that happens, the heirs must either sell the property or pay the loan to keep it, meaning this can be a huge stumbling block for families looking to build generational wealth. What they are good for, though, is holding into your home when the flow of cash coming into your bank account is low or unreliable. You must be at least 62 years old to qualify for a reverse mortgage, and you are required to meet with a housing counselor before pursuing this option. Reverse mortgages don't have income requirement, but they do require that you can pay your basic obligations such as property tax and homeowners insurance.